market news now, European stock markets dipped today and the US dollar nudged higher as weak Chinese trade data had investors fretting about softening global demand, while attention turned towards next week's pivotal inflation data and the Federal Reserve meeting. Meanwhile, locally, African Bank, the group that reinvented itself after its near collapse in 2014, posted an interim loss as retail customers came under pressure from the rising costs of living. The group reported a total net loss after tax of 44 million rand for the interim period, which compared to an interim profit of 372 million rand for the corresponding period the previous year, thanks largely to soaring impairments in its consumer banking division. To give us the latest when it comes to the markets, we are joined on the line by Chantal Marks from FNB Wealth and Investment. Chantal, thanks so much for joining us this afternoon. Take us through what's driving markets and what the JSE performance looks like at this point.
Good afternoon, Natasha. You said it in your intro. Markets seem to be waiting at the moment for what's going to come next week. There's a lot of data that's set to come through next week. There's not a lot going on this week, and we can see it in the way that the market is behaving. From a JSE perspective, it seems as if there really is a lot of renewed interest in the SA Inc. space. For the last 3 days, we've seen the mid-cap index increase quite nicely, as well as the financial 15, which is kind of the indicators that we would look at if we consider SA Inc. It's been really great from that perspective, but I think that we won't really know if this is the start of anything before next week.
I mentioned in my intro that African Bank published their results. Were there any standouts for you when you look at those numbers?
Well, the fact that they posted a loss, I think, stood out to me, and the reason for that loss being an increase in impairment charges. So that basically means that African Bank expects its clients to perform badly in terms of paying back their debt or the loans that they took out. And they've cited specifically the consumer division, so that means the average man on the street, as really having trouble at the moment in high inflation, additional costs, pressure on the employment. And I'm thinking that this year to come in some of the large banks, not nearly at the level that we've seen at African Bank. Of course, they've got a much more diverse client base, but it is concerning that the consumer is feeling the crunch to this extent.
Speaking of the consumer, and I'm thinking rather we are starting to see that come through a little bit when it comes to some of the JSE listed companies, especially when you look at the numbers that they've published. They do mention the constrained consumer. What do you make of some of the locally listed earnings that we've seen so far over the past few weeks?
I've actually been quite impressed, particularly with some of the food producers. Of course, it's quite mixed. So Tiger Brands really struggled, but we saw RSG Foods come out with much better than expected results, and Premier as well yesterday, performing quite well in the face of really tough economic conditions. Of course, load shedding playing a role there, and then, as you mentioned, the consumer under strain as well. But from what we can tell, these consumer-facing stocks are actually navigating the environment quite well. We would expect further strain if we look at the reporting period that includes the space we are in, or the months we are in right now, the winter months, where load shedding is ramping up and interest rates have increased or continue to increase, and there's really placed strain on the pocket of the consumer. But so far, I think it's actually been better than anticipated.
Before I let you go, Mediclinic officially delisting of the stock exchanges. What do we make of Mediclinic's performance relative to its peers like Life Healthcare as well as Netcare?
So obviously, since the takeout offer came, it outperformed Life Healthcare and Netcare from a share price perspective. But if you consider that Mediclinic, from where it listed on the London Stock Exchange, so that's a few years ago, it's still on the buyout value was down 38%. So it really was an underperformer, I think, in the sector. But generally, the sector has been struggling. Of course, it was struggling with self-made issues like expanding too quickly, Mediclinic going into Switzerland and Dubai, Medcare with the UK division that they no longer have, Life Healthcare with Poland and India, which they no longer have, and then also some of the issues related to South Africa specifically, and of course COVID-19, which I think didn't spare any of the healthcare providers. But I think that investors will now look towards what's next. Is there still an investment case to be invested in healthcare stocks? And if so, which one? Our preference at the moment is for Life Healthcare. We see a few near-term catalysts for the stock, and we have seen both Life Healthcare and Medcare and Mediclinic, for that matter, recover quite nicely post-COVID-19 in terms of occupancies and elective surgeries.
Right. Chantal, thank you so much for your time this afternoon. That is Chantal Marks from F&B Wealth and Investment, giving us her perspective on what's driving markets. We're going to take a quick break. When we come back, we'll have more news for you. Stay tuned.